In 2018, Tom Dundon bought a controlling stake in the Carolina Hurricanes for about $420 million, later becoming sole owner. Since then, the team has made the playoffs every year, secured a long-term lease, and pursued major upgrades to PNC Arena along with the surrounding entertainment and development plan. Now, Dundon is aiming to apply that same playbook in Portland with a tentative $4 billion deal for the Trailblazers. But why would anyone pay that kind of money for a small market team? Reports say that tentative terms put the Blazers' sale price at just over $4 billion, with some outlets placing it closer to $4.25 billion. In the NBA's current climate, that number isn't as far-fetched as it might sound. This year, the league secured an 11-year, $77 billion media rights package with ESPN, NBC, and Amazon, a guaranteed revenue stream that changes the economics for every franchise. Even with strong attendance and one of the NBA's most loyal fan bases, the franchise wasn't expected to approach major market price tags. Now the average NBA team is valued around $4.66 billion. That rise has less to do with local ticket sales and more to do with a future where national and global broadcast deals deliver steady cash flow to owners year after year. Portland doesn't have the national market size of New York or Los Angeles, but in today's NBA, local footprint isn't as decisive as it once was. The global streaming audience is massive, and broadcast money reaches every team equally. Owning a small market franchise now means tapping into the same billion-dollar media pipeline as the biggest cities in the league. This is where the buying logic gets clear. Step 1. Media rights guarantee predictable national revenue for more than a decade. Step 2. Private equity groups and institutional investors are willing to pay top dollar for that kind of certainty. Step 3. That demand pushes up the price of every team, no matter the market. You can see the pattern in recent deals. The Phoenix Suns sold for $4 billion. The Boston Celtics went for about $6.1. The Los Angeles Lakers' full valuation hit $10 billion in a partial stake sale. Against numbers like these, paying over $4 billion for the Blazers starts to fall in line with the trend. Private equity's role is simple. They pull huge amounts of capital and don't need immediate returns. That lets them outbid solo owners, driving franchise prices higher. And in a league where the next media contract could be even larger, those firms see teams not just as sports holdings, but as long-term financial assets. Portland's situation still stands out. Dundon's track record suggests he'll want significant operational control, yet his reported partners have ties that connect directly to the city. On paper, the deal is about future broadcast checks and the NBA's growth trajectory, but location-specific factors, arena upgrades, surrounding development, and real estate plays can make the investment bigger than the team itself. For Blazers fans, the early reports say the team will stay put. That's a relief, but a sale this size naturally comes with questions. What will the new owners want to build here? How will it shape downtown? And how much of this price is really about basketball versus the land and the district around it? Those answers start with knowing exactly who's sitting alongside Dundon in this billion-dollar move and what their stake in Portland's future might be. Leading the charge is a small but well-resourced group, Tom Dundon, current owner of the NHL's Carolina Hurricanes, Mark Czar, co-president of Blue Owl Capital, and Sheil Tile, founder and co-CEO of Collective Global Management. Each brings a specific strength to the table, from sports operations and finance to venture capital and local connections. Czar's firm, Blue Owl Capital, manages roughly $273 billion in assets, a scale that makes them capable of funding projects far beyond player contracts. Blue Owl has already stepped into the sports world with minority investments tied to other NBA teams, a signal that they understand the league's ownership landscape. That depth of capital and experience is the kind of backing that can underwrite major arena renovations and transform the underdeveloped land around the Moda Center into a year-round hub for events, dining, and hospitality. Sheil Tile brings a different kind of capital, social and local. His wife, Dr. Sejal Hathi, serves as the director of the Oregon Health Authority, and the couple maintains a Portland presence. That's a local connection, not just a PR talking point. For fans wary of outside owners looking only at financial returns, having someone in the group with personal ties to the city adds credibility to claims about keeping the team rooted here. Dundon's track record is also worth noting. Since buying into the Hurricanes in 2018, the team has made multiple deep playoff runs and locked in long-term lease extensions with major arena upgrades. But not everyone in hockey circles sees his style as a perfect fit. NHL player agents have criticized what they consider his overly hands-on approach. It's a reminder that success in the standings doesn't erase questions about how an owner manages behind the scenes. In Portland, the group's plans could be influenced by the unique situation surrounding the team's home. The city of Portland recently acquired the Moda Ubiquitous Center for $1,000, along with the land beneath it for $7 million. The Blazers' lease runs through 2030, which means any development or arena modernization must work within that timeframe. The city is already involved in a public-private partnership to update the building, and a new owner with resources and a redevelopment blueprint could accelerate the scope of that work. The economic logic for keeping the team in Portland aligns with their potential redevelopment ambitions. An NBA franchise serves as an anchor tenant unlike almost anything else, driving steady traffic, global visibility, and civic engagement. Restaurants, hotels, and entertainment venues nearby benefit directly from game day crowds and year-round events, and those benefits only exist if the team remains in town. The ownership group has publicly committed to staying, and their investment model depends on it. Still, finances and vision don't automatically guarantee results. The NBA's Board of Governors must approve the sale, vetting both the investor's business background and their proposed plans for the franchise. That approval process could shape everything from ownership structure to how aggressively they can pursue real estate development. Tied to the team, with the pieces in place, a proven sports owner, massive financial firepower, and local ties, the stage is set for a pivotal shift in what the Blazers represent to Portland. What happens next may reach well past what's happening on the court. The likely outcome is that the Blazers stay in Portland. The sale price reflects the NBA's soaring media rights revenue and investor appetite, and the ownership group's strategy appears to hinge as much on real estate and district building as on competing for titles. So here's the trade-off. Would securing the team's future be worth a transformation of the city's sports district that could redefine its civic identity? Proceeds from a Paul Allen estate sale were also meant to support philanthropic causes, adding another layer to how this plays out. Tell us, as a fan or sports professional, would you accept an arena-driven redevelopment if it secures the Blazers in Portland? Drop your take in the comments. This deal is a bet on Portland's brand and real estate as much as it is on basketball.